Hello friends, welcome back to all of you in this new episode of Daily Bitcoin News. Let's begin. There has been an agreement between the United States and Japan. What will be the impact of this agreement on the price of Bitcoin? Due to the crash of Japan's currency Japanese yen, there is going to be a huge-scale liquidity injection in the markets. The US has entered into an agreement with Japan's central bank so that Japan do not dump US treasuries, meaning US government bonds, in the market, i.e. not to sell them. Without the help of backdoor liquidity by US, Japan would need to sell its treasuries in order to prop up its currency, which would lead to US bond yields rising. This can be big financial disaster both for Japan and the US, as Japan is the largest holder of US treasuries. Only 4% of its forex reserves are in gold, the rest almost exclusively are in US treasuries. Because if Japan does this, then there will be even more problems for economies and GDP growth of both the US and Japan. Both these countries are already on the verge of default due to having a much higher debt than GDP. And you can understand that when an entire country defaults on its payments, then what will be its effect in the whole world, and that too for the world's two largest countries in the world's GDP, US and Japan. We have to understand what this liquidity means for the financial markets of the world. And what is the impact of this on the economy of any country? Injecting liquidity into the markets is that process when the central bank of a country like RBI in India or Federal Reserve in the US injects more money into the financial system, that is, in the economy of the country. This is not the money that has come from the GDP of the country. That is, it is not the money that the people of the country and the businesses of that country generate by working hard, day and night, but it is the money that the central bank of the country creates in the balance sheet of that country in some special ways. And then that money reaches the businesses and people of the country by giving loans through banks, such as business loans or personal loans. This is usually done to encourage economic growth and financial stability, especially during times of financial stress and economic downturn. Let us now understand what are the methods using which the central bank of the country creates this extra money in the economy of its country. They are: 1. Quantitative easing, QE, 2. Targeted long-term refinancing operations, TLTROs, 3. Open market operations, OMO, 4. Emergency liquidity assistance, ELA. Now let's understand them one by one. Quantitative easing, QE, is a common method in which the central bank buys government bonds, also known as treasuries, from commercial banks of the country such as HDFC, ICICI, and other financial institutions. This increases the reserves of these commercial banks, and due to which they are able to give more loans to people and businesses. Second method of injecting liquidity is targeted long-term refinancing operations, TLTROs. In this way, central banks provide long-term loans to commercial banks at lower interest rates. This encourages banks to give more loans to businesses and families at attractive rates. Third method of injecting liquidity is open market operations. In this process, central banks buy or sell government securities from the market to manage liquidity. Buying government securities increases liquidity in the system, while selling them reduces it. Fourth method is emergency liquidity assistance, ELA. During financial crises, central banks can provide emergency assistance to distressed financial institutions to maintain financial stability. We call this a bailout in the financial world. For example, in 2008, the U.S. Federal Reserve bailed out large number of U.S. banks and financial institutions by injecting emergency funds to tune of $200 billion. Now what is the effect of this liquidity in the financial system? First effect is lower interest rates. By buying government bonds, central bank increases the prices of those bonds, thereby reducing the interest rates on those bonds, which in turn makes interest rates on loans lower which the commercial banks provide to people or businesses. Interest rates have to be reduced so that investment and consumption can be promoted and economic activity increases in the country. This helps in increasing the GDP of the country. Second effect is more number of loans. With more reserves with commercial banks due to this liquidity, these banks can now give more loans to businesses and individuals, which helps in economic growth. Now a very important effect is how does the liquidity injection affects inflation. On the one hand, where liquidity injection can boost the economy, on the other hand, There is also a fear of higher inflation because due to liquidity injection, too much money in the economy chases very few items, thus, demand of things increases, while the supply of those things is available in the markets only at their earlier rates, due to which the prices of goods in the markets go up. Overall, the purpose of the liquidity injection is to make loans more available, to lower interest rates, to boost economic activity and increase GDP of the country. Now you should know which asset class is going to be at advantage when this liquidity will be injected into the financial markets. That asset is Bitcoin. Let's understand what does this liquidity injection mean for assets like Bitcoin that absorb liquidity, and how it can benefit you. Today, big asset managers and investors from all over the world like BlackRock, Fidelity, are also buying Bitcoin. Excess liquidity in the markets has been having a very significant impact on the price of Bitcoin and other cryptocurrencies. And it has always been bullish for all risk-on assets such as technology stocks, Bitcoin and other cryptocurrencies. So what is the effect of excess liquidity on the price of Bitcoin? First is increased buying power for Bitcoin. Additional liquidity means that there is more money to investment. Investors start investing in assets like Bitcoin to get higher returns, which increases the demand for Bitcoin and thereby increases the price of Bitcoin. Second effect is lower interest rates helps increase Bitcoin price. With central banks injecting liquidity, interest rates often go down, due to which traditional assets such as government or corporate bonds or savings instruments like FDs now get less returns, due to which it makes traditional investments less attractive. Therefore more investors begin to invest money in Bitcoin and other cryptocurrencies. Third effect is market sentiment becomes favorable for buying Bitcoin. The injection of liquidity uplifts the mood of the markets, making investors more willing to take risks. Cryptocurrencies and Bitcoin, being high-risk assets, can benefit from this increased risk appetite. Fourth effect is Bitcoin becomes hedge against inflation. Due to excess liquidity, the fear of inflation rising higher increases. Bitcoin is often seen as a hedge against inflation, so Bitcoin's attractiveness increases as an investment during times of high liquidity. So finally we can conclude that excess liquidity can lead to increased demand for Bitcoin, because, first, investors want higher returns, second, Bitcoin has been the most successful inflation hedge so far, compared to gold, stocks, and bonds, and third, better market conditions are created in the crypto world due to higher investments in these markets, which further promotes new innovations in this emerging asset class of Bitcoin and cryptocurrencies. So friends, that's all in today's episode of Daily Bitcoin News, DBN. I hope you guys liked this episode. For such daily important updates, please subscribe to this channel and like the video. Friends, if you keep yourself updated with developments related to Bitcoin, then you will also be able to benefit from the biggest financial breakthrough of our times, and that is Bitcoin. Thank you so much. Be happy and be wonderful. Keep increasing your financial knowledge. See you in the next episode of DBN. Goodbye.